Welcome back to Wall Street Podcast. Today we're doing a rapid deep dive into JPMorgan's latest Asia Tech Strategy Report. It's dated June 24, 2025, so really hot off the presses. Our goal here is pretty simple. Cut through the noise, give you direct, actionable insights on AI and the whole Asian tech scene.
Yeah, and the first thing that really jumps out is just how dominant AI still is. I mean, look at Asian tech earnings revisions. They're up 18% year to date. That's huge.
18% just since January.
Yeah, exactly. And it's overwhelmingly driven by, well, the AI complex. And JPMorgan, they're not really pulling back. They're projecting another, 15-20% potential upside for Asian tech stocks by the end of 2025.
Okay, and this is interesting. The report says we're now in the second half of the AI hardware upcycle. Now, second half might make some listeners think slowdown, but JPMorgan seems to read it differently.
That's right. They highlight these classic signals of a phase that's mature, yes, but still strong. You've got demand holding up, lead times actually getting longer, inventories rising a bit, and the bottlenecks are shifting around.
So what does that actually mean for you if you're invested or thinking about it?
Well, it suggests a really crucial shift. It's moving away from just, speculative valuation bumps towards fundamental earnings growth. The report really hammers this home. It's not just hype driving things anymore. It's about performance, about delivery. Makes stock picking even more critical for you.
Makes sense. Okay, let's dig into some market specifics then. Semiconductors, for example, we're 19 months into this year-over-year growth upturn. JPMorgan thinks there's still, 20-25% more EPS upgrades possible? That sounds quite bullish.
It is. And importantly, they're saying there aren't really signs of the usual excesses right now. Things like massively stretched inventories that usually pop up before a downturn.
Okay.
So this analysis suggests the uptrend probably has more room to run, maybe into early 2026, supporting those potential EPS upgrades.
So linking back to valuations, JPMorgan notes AI tech valuations have mean reverted. They're back around historical averages. If the easy gains from just valuations going up are mostly done, where's the upside coming from?
Exactly. It's got to be earnings driven now. That's the core message. So key AI enablers, think TSMC, SK Hynix, Advantis, Delta, they seem poised for more momentum because their profits are expected to keep climbing. And also keep an eye on the NVDA server ODMs, companies like Quanta.
The original design manufacturers.
Right. They could actually see a positive reversal in the second half of 2025 as those big server rack shipments really start to ramp up.
Okay, so AI still looks strong, driven by earnings.
All right.
But JPMorgan does flag some caution elsewhere, right? What about non-AI tech for the second half?
Yeah, here they're definitely more conservative, advising caution. Seems to be because some of those China consumption subsidies are fading out, plus you had some demand pulled forward earlier this year because of tariff concerns.
Tariff pull-in effects, right?
Yeah.
So maybe less organic growth there near term.
That seems to be the thinking.
But looking further out, maybe late 2025, are there any new themes emerging that could get people excited about non-AI tech again?
Yes, absolutely. The report actually highlights two specific things to watch. One is the foldable iPhone cycle whenever that properly picks off, and the other is smart glasses or AR glasses. These could become pretty significant drivers, especially if they find cool new ways to use generative AI.
Interesting. And quickly, what about automotive and industrial sectors?
The view there is that the recovery looks pretty early stage. There's a risk of a pullback in the second half. Maybe some of the Q2 demand was more about that tariff pull-in rather than a really solid, sustained recovery starting.
Okay, got it. So pulling all this together, what's the big picture investment strategy JPMorgan is recommending right now?
It's actually remarkably clear. They explicitly advise against a big rotation away from AI stocks over the next, say, 3 months. The recommendation is basically run the winners.
Run the winners.
Yeah. And their top picks really reflect that. TSMC, SK Hynix, Advantis, Delta, Quanta. And on the flip side, they suggest avoiding names like SMIC, UMC, and Nikon, as mentioned too.
Okay. And looking ahead, what are the key potential catalyst positive ones for Asian tech stocks?
They list 3 main things for you to watch. First, any news that reinforces strong AI data center spending, CapEx, continuing into 2026. Second, maybe potential U.S. approval for those specific AI chips NVDA wants to sell into China. And third, just better than expected demand in non-AI sectors in the second half, mainly because expectations are pretty low right now.
All right, let's try to connect a few final dots for you as we wrap this up. We talked about AI tech valuations being back at mean levels. So beyond just hoping valuations expand again, what does JPMorgan see as the main engine for upside from here?
Yeah, the key takeaway is really that shift to EPS upgrades earnings per share. The report points to strong demand, pretty constructive comments about AI compute availability. It all suggests what they call an uneasy grind up could continue well into mid 2026. So, steady growth driven by earnings, not those wild speculative jumps.
Okay. And then thinking about that caution on non-AI tech for the rest of this year, what specific niche themes could really emerge by year-end that might shift the narrative and get investors interested again?
Well, this really gets to the question of what's next, beyond the current AI focus. The report specifically calls out, again, the foldable iPhone and SmartR glasses. These aren't just minor product updates, they could be significant if they show new, compelling ways to use generative AI. That could open up whole new markets.
Makes sense. Finally, this semiconductor upturn. It's 19 months old. Past cycles often run longer, maybe around 30 months. Does this report see any warning signs of a peak forming now, or does it suggest there's still runway left?
Looking at the bigger picture here, the report is actually pretty optimistic on this point. It specifically notes a lag of those typical excesses like crazy inventory levels or obvious oversupply that usually signal a top is near. So the implication is there's likely still significant potential for more EPS upgrades in Asian semis, supporting this uptrend well through early 2026. Definitely something for you to consider as you navigate the next few months.